You opened your portfolio, saw SCHD down again this year, and thought, wait, isn't this supposed to be the safe one? You're not imagining things. As of May 2025, SCHD is down nearly 5% year-to-date. That's not catastrophic, but it's enough to make you wonder, is this ETF still doing what it's supposed to do? Especially when tech is down too and bonds aren't much help either. It starts to feel like there's nowhere to hide. And here's a quick disclosure. I do personally hold a small portion of SCHD in my own portfolio. It's not the biggest slice, but I do believe in what it's trying to do long-term. So today, we're going to dig in, not just into the price, but the purpose of SCHD. Because there's a reason long-term investors are still holding, and even buying more, of this so-called boring ETF. We'll break down why SCHD is struggling right now, how it actually works behind the scenes, and whether it still fits into a long-term strategy built on peace of mind, not performance chasing. SCHD has built a reputation as a rock-solid dividend ETF, but 2025 hasn't been kind. Between tariffs, oil price swings, and general market anxiety, even the usual safe bets are wobbling. SCHD is down about 5% this year. QQQ, the growth-heavy tech ETF, is also down. So is the S&P 500, just a little less. And here's the thing. When everything's falling, less bad can still feel bad, especially when you expected SCHD to protect you from this kind of volatility. But here's the first mindset shift. SCHD is not built to avoid all declines. It's built to recover better and pay you while it does. To understand that, we need to talk about how this ETF actually works. SCHD isn't just a basket of dividend stocks. It tracks the Dow Jones U.S. Dividend 100 Index, but the real power is in how it picks what goes in. Here's the full breakdown. It all starts with U.S. companies. No international stocks allowed. To even make the first cut, a company must have paid dividends for at least 10 consecutive years. It also needs to be a decent size, with a market cap above $500 million, and trade enough each day to meet a minimum liquidity threshold, at least $2 million in average daily trading volume. Next comes the first screen. Sort all eligible stocks by dividend yield, then cut out the bottom 50%. What's left is the high-yielding half. But here's where SCHD gets selective. Each remaining company is scored equally across 4 criteria. Return on equity, how efficiently a company turns profits from shareholders' equity. Free cash flow to total debt, a measure of how much cash the company has available to pay off its debt. 5-year dividend growth rate, how consistently and strongly the company has increased its dividend over time. Dividend yield, how much income the stock pays out each year relative to its price. These scores are combined into a composite ranking. The top 100 companies are chosen, and that's your portfolio. The result? SCHD doesn't just chase yield. It filters for companies that are financially solid, cash-rich, and shareholder-friendly. You'll see names like Coca-Cola, Home Depot, Amgen, and Cisco, not because they're exciting, but because they have strong cash flow, manageable debt, and consistent dividends. Even in 2025's mess, these businesses are still selling soda, running pharmacies, processing network traffic, and generating real income. That's what SCHD filters for. Not hype, but resilience. Now, how does SCHD compare to other popular dividend ETFs? Let's take VIG, for example, the Vanguard Dividend Appreciation ETF. VIG focuses on companies with at least 10 years of dividend growth, but it doesn't screen as deeply for financial quality like SCHD does. It also excludes the highest-yielding stocks entirely, which can make its yield lower overall. VYM. That's Vanguard's High Dividend Yield ETF. It goes in the opposite direction. It includes over 400 companies, many with high dividend yields, but the screening is broader and less strict. That means the yield is there, but not always the same level of financial rigor. And then there's DGRO, the iShares Core Dividend Growth ETF, which blends a bit of both. It includes companies with at least 5 years of dividend growth, solid payout ratios, and projected earnings growth. But again, the focus is spread out over hundreds of names. What makes SCHD unique is that it combines yield and quality with discipline. It narrows the list to 100 companies, and only the ones that score well on both financial health and dividend consistency make the cut. In short, SCHD gives you fewer companies, but stronger filters, and that's what gives it its quiet confidence. Here's what most investors are missing right now. SCHD's price is down, but its income isn't. As of May 2025, SCHD offers a dividend yield of around 4.1%, one of the most attractive levels it's had in recent years. You're getting more income at lower prices from companies that have been financially screened harder than most mutual funds do. And the long-term story? It gets even better. If you'd bought SCHD in 2012 and just held it, your dividend income would now be yielding around 9% on your original cost. That's what we call income compounding. And it's the real secret weapon of dividend growth investors. Even when your portfolio looks flat or negative, your cash flow keeps climbing. And over time, that's what builds freedom, not chasing the next hot stock. Okay, but still, why is SCHD underperforming? Part of it comes down to recent changes. In March 2025, SCHD rebalanced. It increased energy exposure from around 11.4% to nearly 19.8%, while trimming back on financials. Unfortunately, energy stocks have struggled this year, thanks to weak oil prices and tariff-related disruptions. That's hurt SCHD's short-term return, but the companies inside SCHD, like Pepsi, Coca-Cola, Home Depot, Texas Instruments, Amgen, haven't turned to junk overnight. In fact, Wall Street analysts give many of these names 20% to 40% upside from current prices. So when SCHD falls and those businesses haven't deteriorated, what you're looking at isn't decline. It's discount. So, is SCHD still worth it? Honestly, that depends on what kind of investor you want to be. If you're looking for fast rebounds or want exposure to high-flying tech, this probably isn't your best fit. But if you want growing income from cash-rich dividend-growing companies at a discounted price, then SCHD might be your quietest ally right now. It's not meant to impress at parties. It's meant to quietly, steadily transform your financial life. So yes, SCHD is down in 2025, but it's not broken. And more importantly, the income engine is still running and stronger than ever. If you want to see how this plays out over time, how a simple ETF like SCHD could one day pay you thousands each month, check out my earlier video, Realistic Ways to Earn $2,000 per month from US Dividends. In that one, I walk through the numbers, the timeline, and exactly what it takes.